So on the left-hand side, they are the demand for different policies. And the other side, they are firm, they are the supplier of the dividend. All right, so we have some low or zero to low payout stock. I mean, they all have capital gain. They do not pay any dividends. And some pay low to medium, and some pay medium dividends. Some they have very high payout ratio. So maybe they pay out 100% of the earnings. All right. Now on the other side, we have some high tax bracket individual. So since they have a very high tax bracket, so they want to defer the gain until they sell the stock maybe at 65 when they retire, not 20, not 30. All right. So those individuals, they prefer a very low or even zero dividends today. All right. Now this next is those who have a lower tax rate. They are retirees, so they don't mind having a little bit dividends, but too much dividend is not a good thing, because if you receive, let's say, $100,000 dividend, your marginal tax rate will be something like 35%. All right? Okay? So for those people, yeah, dividend is fine, but not too much. Now, at the third group, they are tax-free institution. So tax-free institution includes some, let's say, foundation, and so those foundation or trusts, they need both operating cash flow, especially if you look at US. If you are a foundation, you have to pay out certain amount of asset in each year. All right, so let's say 10%. Okay, and also maybe you have a foundation at university, and this foundation is to support, let's say, an annual scholarship. So you need cash flow to pay the scholarship, but you also want to reserve the value and also maybe grow. So in the future, you may pay more scholarship. So for those foundations, they don't need to pay tax. So they don't mind having, they actually need dividend because they have to pay the scholarship, or sometimes the foundation is to support the operation of a hospital. So you need some money to run the operation, all right? But they also want growth so that they can expand the scale of the hospital or operation. So for those company or those institutions, right, they want median payout stock, okay? The last one are corporation, so they are actually tax-free on dividend received, all right? Now, so I just give you a very simple example. So let's say this is company A and company B and company C, all right? So if company B owns some of the stock of company A, and when A paid dividends, all right, now in Canada, you have to pay tax on the dividends you pay, all right? So you have to pay tax, but you get a tax refund when you pay the dividends, the money, the amount of dividend, to your shareholder. So let's say to company C. So if we do not have this kind of refundable tax, this will be double taxation. All right, so let's say even triple taxation. So this is you. All right, so C may invest in B stock, B invest in A stock. So when A pay dividend to B, pay dividend to C, C pay dividend to you. In this case, there will be triple taxation. All right, so the government said, no, we don't want this to happen. Otherwise, no firm will invest in our company equity. So when B receive dividends from A, they pay tax on it. But when they pay the money, so they keep track of how much dividend they receive. So that's a cap. So when they pay dividend to C, now then B will get a refund from the CRA. So we call it refundable tax. So basically, Canadian firm, they don't need to pay tax on dividend they receive. All right. Same thing for C. So when they receive a dividend from B, they pay tax. But when they pay those money to you, they get a refund. All right. So therefore, the effective tax rate on dividends is 0 for Canadian corporation. All right. So for those companies, they don't mind getting dividends. They actually want dividends. They want to get the money back as early as possible. All right. Okay? If they sell in the future, the capital gain, they have to pay capital gain tax, but dividends is free for them. Okay? So the clientele effect argument is when the demand of dividends equal to the supply of the dividends, then nobody should change your dividend policy, right? Because we are at equilibrium. You should only change your dividend policy. So let's say, for example, I just make up some number. So let's say we have 10 high tax bracket individual, we have 10 low tax bracket individual, we have 10 tax-free institution, we have 10 corporation in this world. At the same time, there are 10 low to or 0 to low payout stock. We have 10 low to medium payout stock. We have 10 medium payout stock, and we have 10 high payout stock. So assume everyone just won $1. So now we're at equilibrium, demand equal to supply. Now the only thing you should change your dividend policy is when there's a change in demand. So let's say, for example, one of the individual, they retire. All right? So when they retire, they don't have any other income, so now their marginal tax rate will be much lower. So at this point, we have only 9 individuals that have a high marginal tax rate, and we have 11 individuals. They have low tax rate. So now at this point, demand is not equal to supply. So if we have this equilibrium, so one of the firm, they should change their dividend policy. So that's what the clientele effect argument. All right? If there's no shock in the market, we should not do anything unless there's something happen. Okay? Now the empirical evidence, that's what we observe in the real world. Yeah, corporations, they do pay dividends, and they actually smooth the dividend. So I said, well, you seldom or hardly find companies that have dividend up and down. So they steadily increase the dividend over time. All right? And dividend provide information to the market. That is, we find that firm will have positive abnormal return when their dividend is higher. All right? And when they declare a cut in dividends, they have negative abnormal return. Okay? And then our conclusion is, well, you should never, theoretically, you should never forego positive NPV project in order to pay a dividend. All right? And you should not issue stock and pay dividends as well. All right? Although in real world, yeah, we observe this kind of behavior, but in theory, you should not do that. But once you have extra cash and you want to pay out to your shareholder, well, consider repurchase, or maybe just one-time special cash dividend. All right? So that's the conclusion of dividend policy. Again, no magic formula to determine what's the optimal capital or dividend policy. All right? If yes, then there's no finance. Right? It's always because in this real world, there's so many things happening at the same time. So what we learn here is a fundamental issue of dividend policy. That's how you make future decisions. Okay? Now, next, we move on to chapter 20 and chapter 22. So this week, we will cover chapter 20. And since we have a midterm next Monday, so there will be no quiz this week. All right, so just focus on your midterm. All right, and I believe, every year I say the same thing. I believe this is the easiest midterm I have in my career. Right, but I said that every year. Okay, but this may be true this time. Okay, this may be true this time. Just let's see. All right, because I stop myself several times. Oh, don't make it harder. Don't make it harder. This is enough. This is enough. Okay, so let's see. Now you'll find out next Monday. Okay. Right. Now, well, when you go public and want to sell shares to the market to generate people, all right, and we know there will be regulator. But nowadays, a lot of people say we don't need regulator, especially the cryptocurrency market, right? Yeah, they have the argument, but at the same time, whenever there's any problem with any crypto, they say, okay, we need some regulation. All right? I don't know, they just keep move back and forth always, right? If you look at what happened a week ago, the Libra, the meme coin, well, that's terrible, right? Especially endorsed by a president of a country, right? Even some of the country president, they have their own meme coin, right? So that's terrible, okay? Approve a lot of, just let a lot of thousands, or actually not thousands, millions of investors just holding their back at the end. All right, okay? But no matter what, trust me, regulation is something we need, right? I know everyone, nobody wants to be regulated, right? But if there's in a market, there are a lot of large, well, vulnerable people or not that well-educated people, right? They will be easily hurt by those scammers. We know that. So that's why we need regulation. Now in Canada, we have different provincial regulators. So we have provincial regulatory commissions, and the CSA, the Canadian Security Administrator. They are not a regulator. All right? They are just a coordinator. Who are their members? The commissioner of the provincial regulator. So let's say if you are the commissioner of the OSC, Ontario Security Commission, you are a member of the CSA. All right? What their job is try to coordinate. So there is not a regulator. All right? So if you listed on Tier 6, of course you're under the jurisdiction of the OSC, Ontario Security Commission. So they have Alberta, they have the Alberta Security Commission, and each province, they will have their commissioner, right? So later on, we will have a new province, right? We are saying that U.S. is going to be the 11th province of Canada. I don't know, right? If that's the case, it's a nightmare to me, I believe. Okay, if they do that's true, all right? Okay, so what is the purpose, objective of regulator? So they try to make an efficient flow of information. That is, everyone in the market, you should have the same information as others. So everyone should be fairly treated. We know information is king in the financial market. If you know anything just a few seconds before others, you can make a fortune out of it. All right? So therefore, the regulator must make sure that everyone should have the same information. So efficient flow of information. And you have a smooth functioning of the security market. All right, okay, all right. Now, in the US, they have one national regulator, so the SEC, all right? But in Canada, we don't have a national regulator. So we just have provincial regulator. So this idea was out there for decades, or let's for 2 or 3 decades, arguing whether we should have a national regulator in Canada. All right, but still no one single regulator now. Okay, right now we are using the passport system. So the passport system basically just mutual recognition. That is, well, you are in Alberta, and now you go to Quebec. They just have mutual recognition. That's it. All right, and very likely, we would not have this kind of national regulator in the next 5 or 10 years. But maybe 20 years or before I die, I don't know, right? There's a lot of resistance from at least 2 provinces. One is Quebec, the other one is Alberta, all right? And Ontario, of course, they want to have a national regulator. Because what happened is, if we have one national regulator, very likely it will be in Ontario because we have TS6. Right? Montreal or Quebec, they have MX. But MX is only for futures and derivatives. Right? But stock, bond, they are in Toronto. So if we have one national regulator, very likely it will be in Ontario, and that means Ontario will have more power. So if you are the commissioner of, let's say, in Alberta or in Quebec, you don't want to lose your control. So that's why there are the 2 provinces that were against this idea for decades. All right? But as long as they can have a good coordination, I'm fine with that. All right? But if you have one regulator, national regulator, I think it would make a little bit more efficient for the Canadian financial market. All right. Now here we have some basic procedure for a new issue. So if you want to sell security to the public, first of all, you need to get the approval from the board of directors of the company, all right? And then you prepare a preliminary prospectus and send it to the OSC. So the prospectus will include all kind of information about the company, their forecast, their financial position, and what the money is for, how much they want to raise, all detail, right? Risk, especially risk, right? What kind of investment risk investor may have or may encounter if they invest in your company or buy your company stock, okay? Now, the OSC will review the preliminary prospectus and may notify the company they need extra information, right? If you respond and then they say, okay, I'm fine with all this information, they will approve your prospectus, and then the company will go ahead and promote and have a roadshow and sell the security to the public. So that's the general step. All right, okay? So this is a timeline. So how long it take? So first of all is pre-underwriting conferences. So it may take several months, sometimes even longer. All right. So here is the discussion. Now the syndicate, underwriting syndicate. All right. So the underwriting syndicate, they are the investment banker. So why they need a syndicate? So first of all, they can spread the risk. So let's say I am, one of the investment banker. So let's say today we will look at Facebook IPO. So in Facebook IPO, Morgan Stanley was the lead underwriter. All right, so I'm Morgan Stanley. So now Facebook want to sell $60 billion of the stock. Well, that's 14 years ago, 2012. Right, actually 15, 14 something. So that's a huge amount of money. So I may not be able to sell all the stock to my client. All right, so therefore they form a syndicate. That means they invite other investment banker. So let's say you are JP Morgan, you are Goldman Sachs, and now, so out of, let's say initially they plan to sell 421 million shares. So I may pick up 50% of those shares. And I give you 20%, I give you 20%, I give you 10%. So now you promote or sell those shares to your client. All right? So this is a syndicate. So maybe in this deal, I am the lead underwriter. In the next deal, you may be the top, the lead underwriter. So this time, you give me 10% of the shares the company want to issue. So in this case, you can satisfy all your customers. Otherwise, if I only sell, let's say, exclusive, this is an exclusive deal. I'm the only underwriter. So if you are the client of this underwriter, you may not be able to buy the share from your company. All right? So you are not happy, your client will not happy, so that's why they form a syndicate. So try to make everyone happy, right? And also spread the risk, because I don't need to sell all 421 million shares, right? So if I have 50%, I only need to sell about 200 million shares. And then you have maybe 20%, that's 80 million shares, 80 million shares, and then 20 million shares, or 40 million shares. All right, so that's why we need to form a syndicate. All right, now next is the registration statement. So that means you file prospectus and everything, and then you have to wait, and they review, the OSC will review your document, or US SEC will review your document. And then now, you have to determine the issue price. Now, we already call a seasoned offering and an unseasoned offering. Now, a seasoned offering is, that means I'm a company listed on stock exchange. I just want to issue more shares. We call it a seasoned offering. Right? Now, if I'm a new company, I'm a private company, now I want to list it on stock exchange, and this time it is an unseasoned offering, or IPO, initial public offer. All right, so seasoned and unseasoned is whether you are a listed company or not. So for seasoned offering, the price normally is easy, very close to the current market price. maybe a little bit higher and a little bit lower, because we cannot predict the future price will be. All right? But the offer price will be very close to the market price now. Okay? But for unseasoned offering or IPO, then we have to do a lot of research. So the underwriter, they have to set up a team, do the valuation, they may set up some kind of model, and then they need people, they send people, sometimes that's why we need accountants. So they need accountant, they need accounting firm to audit, provide, or review all the financial statement. Right? So that's why in Big Four, accounting firm, they have M&A team, they have IPO team as well. All right? So they may send some people to, let's say, overseas to make sure the asset is there. All right? Maybe the company says, I own a huge amount of a big piece of land in, let's say, somewhere in another part of the world. So you have to send someone there and want to make sure the land is there. Right? You may argue you have a factory there, they want to verify this is correct. All right? So that's what we call the due diligence. Okay? All right? So now you do all the research, you set up the issue price, and then after you determine the price, then you sell the share to the public, right? Using an IPO. Okay? So we will talk about what a firm commitment, what's the best ad for this later on today. All right? Now after the IPO, there is what we call a market stabilization period. All right? Usually it's 30 days. So this market stabilization is, as an underwriter, I try to keep the price at the offer price or above. All right? I try not to let the market price below the offer price. There's several reasons I want to do this. One is, well, you keep a good reputation, so in the future, more company will hire you as an underwriter, all right? Because you can keep the market price up. Second is I want to have happy customers, because I promote, I sell the share to my clients, all right? So every time you buy share from me, you lose money, then you will go to other underwriter or other investment banker, all right? So you want to make your client, your customer happy. So you try your very best to maintain the price at least at the offer price. So we call this stabilization period. All right? Now, in Canada, now we also they have similar system. They call it the shelf registration, but in Canada they call it the POP system, the POP. Now, POP is just a short form prospectus. That means if you apply for a POP system, let's say I am a listed company. I have the IPO and I'm listed on the TSX. All right? And now, if I want to issue more share, then I have to go through the whole process again. That is, you have to prepare a full prospectus. But if I apply the POP system and they approve it, then you don't need to prepare a full prospectus. So what you need is just to prepare a short form prospectus. So the time to issue new share will be shortened if you are under the POP system. All right? Because under the POP system, you have to continuously provide information to the OSC. All right? That means from time to time, you submit all the information to OSC. So now if you need new capital and you want to issue new share, so OSC only need a little information. That's the short form prospectus. All right? And all they need is just review your short form prospectus, and the review process will take a much shorter time. All right? So that's what we call the POP system. Okay? Now, when you issue shares, there's two methods, either using a cash offer or rights offer. So a cash offer is, well, you sell the share to everyone in the market, all general public. That's a cash offer. All right? Now, usually if the IPO, then it has to be a cash offer. All right? If you have an IPO, this is the first time you sell the share to the public, it has to be a cash offer. But if it is a seasoned offering, That is, you are already listed on stock exchange, and now you want to raise more capital by issuing new share. You can use the right offering. The right offering this time is you only sell the share to the existing shareholder. We call this right offering. All right? Now today we will look at how right offering works today. All right? So right offering actually is a dividend policy. You can consider this as just a dividend policy. So they just give you a dividend, but they do not give you cash dividend. They give you the right to buy the new share at a discount price. So we will talk about that today. All right? So as I said, IPO unseasoned offering is usually as a cash offer. Secondary or seasoned offering, it may be a cash offer, it may be a rights offer. All right? Now, in a cash offer, so as I said, there's an underwriter. Now, the difference between the underwriting buying price and the offer price is what we call the spread. All right? So in Facebook example, so even though they call it Meta, but I still want to call it Facebook because that's the name they have at that time when they have the IPO, right? So on one side we have the company Facebook, all right, and on the other side, of course, we have the investors. Right, we have the investors, all right. Now in the middle, we have the investment banker. So the investment banker. So in Facebook case, the lead underwriter is Morgan Stanley. All right, Morgan Stanley is the lead underwriter. Bank of America, other, let's say, as I said, JP Morgan and Goldman Sachs. They are also other members in the syndicate. Right? Okay. Okay. Now in Facebook case, at the very beginning, the offer price was about $30 to $34, and since they observed there's high demand of a share, they raised the offer price to $34 to $38. Right? And the final decision, of course, is $38. So that means if you are an investor, you have to pay $38 to buy one share from the underwriter. All right? But the underwriter, they do not need to pay $38 to buy the share from Facebook. They only need to pay, I missed that number, so I have to use this one here. Now, they only pay $37.582 for each share to Facebook. So that means this is a 1.1% spread. So the spread in this case is 1.1%. So usually it's a percentage of the offer price. All right, so in this example is 1%. Now the initial transaction, Facebook want to issue 421 million shares. So this is the number of shares they want to issue. All right, so if you look at it, 421 million times $38 per share, that was about 16 billion. All right, so that's the deal. Now, for underwriting, so it may be a regular underwriting. So regular underwriting means it may be either firm commitment or best effort. All right, so firm commitment means as an underwriter, I guarantee the 421 million shares. All right, so if the demand is only 400 million, so the remaining 21 million shares will be brought by the underwriter, Morgan Stanley. So this is a firm commitment. So under a firm commitment, the firm will 100% sure they can sell 421 million shares. All right? Now, best effort means as an underwriter, I don't guarantee the full sales of the share. So I just try my best to sell the share to the public. All right? But of course, when they have a roadshow, when they run the book, they normally has an idea of the demand of the share. Because a lot of institutional investors, they already put the order before the IPO. All right? So they make commitment how many shares they want to buy. So best effort is no guarantee. So if I can only sell 400 million shares, the remaining 20 the remaining 21 million will be returned to Facebook. All right, so that's the best effort. Now, block deal in an SR type. Now, block deal is very similar to firm commitment, but the timing is just a little bit different. Block deal means the underwriter purchase or buy the 421 million share from Facebook first, and now pay the money to Facebook. Now, Facebook is none of your business now. Next step is how you sell the 421 million to the public. So this is a block deal. So it's also guaranteed the full 421 million share will be sold because the underwriter purchased the 421 million share first from Facebook, and then they sell it to the public. All right? Firm commitment this time is, as an underwriter, I do not purchase share from you first. I actually sell the share, talk to my customers how many shares they want first, and then, okay, now, if there's firm commitment, I guarantee the sales. If there's anything left, I will buy. All right? So block deal actually is quite common in Canada, especially a lot of IPO in Canada are much smaller than the US IPO or other parts of the world. All right? So Canada is still a big financial market, but it's not as big as UK, US, or even Hong Kong. Okay, all right? So therefore, in Canada, block deal is a very common practice because the size, not only the size of the deal is manageable. Okay? Now, the cash offer, what we call it the selling period. All right? So the underwriter, they agree not to sell any security for less than the offer price until the syndicate is solved. So this is the selling period. Now, very important provision, there's a very important provision is what we call the over-allotment option or over-allotment provision. All right? And it's also known as the green shoes provision because Green Shoes was the first company many years ago. They had this provision. Now, this green shoe provision allowed the underwriter to buy extra shares from the company. So in Facebook case, it is up to the underwriter, the investment bank, whether they want to buy another 15% of the share. So 15%, that means 63 million shares. All right? So it is up to the underwriter. So if the underwriter finds, okay, the demand is not that high, so they just, okay, let's go for the regular 421 million. But if the underwriter finds there's a huge demand of the stock, they may ask Facebook, hey, I want extra 63 million shares. All right? And Facebook, they have to sell extra 63 million shares at a price of 37.582. All right, to the underwriter, and the underwriter sell to the customer 38. All right. Okay, I think this building is safe, so don't worry. Right? So that means they can earn more spread, right? 63 million shares. Now, another beauty of this over-allotment option, actually, as an underwriter, this option is extremely, extremely valuable. All right? So what happened in 2012 when Facebook had this IPO? Now, at that time, Morgan Stanley and other companies, other underwriters, initially, they did not sell 421 million. They actually sell 484 million shares to the public. So even before they exercised this allotment option, they sold 484 million shares to the public. All right? Because initially this is only the amount of shares. So therefore, Morgan Stanley and other underwriter, they have a short position. They owe their customer 63 million shares. All right, because Facebook only agreed to sell 421, but they sold 484 to their customers in total, because they know there's high demand. All right, okay. So what happened is, hey, if the price of Facebook is high, right? Let's say on the first day or first few days of trading, the price is $45. Actually, this is true. The price went up to 45 just a couple of days later. All right? So in that case, as an underwriter, you still owe your customers 63 million shares. Right? Because they will pay you 38, that's the price they agreed to pay, and you have to deliver the extra 63 million shares to your customers. So in that case, what you do is go to Facebook and say, oh, I will exercise that over allotment option, because that option allow me to purchase another 63 million shares from you at 37.582. All right? So if the price is high, as an underwriter, I will exercise this option and buy 63 million shares from Facebook and then deliver to the customer. All right? So that's good. That's good. I don't need to worry about it. Even I sell 484, I know my position has been covered by this option. Now, next, what happened is, hey, what happened if the price of the stock is below 38? All right? Actually, on the first day of trading, the price closed at 38.23, I think. That's a little bit higher than $38. All right? And during the day, the price sometimes dropped slightly below 38. All right? Now, at that time, what happened is, if the price is dropped below $38, let's say, just for example, the price dropped to 37. All right? If the price dropped to 37, actually, if you are the underwriter, you make more money, because the extra 63 million, the customer, they promised to pay $38 to buy the extra 63 million. So this time, you do not exercise the option. You do not go to Facebook. You actually go to the market and buy the share at 37. And then you buy 63 million shares and deliver the share to the customer. You actually make $1 profit now. Right? And another thing is the stabilization period. Remember, we have the stabilization period. That is, you try to keep the price close or higher than the offer price. So when we look at the data on that day, well, of course, Facebook, they have a terrible IPO on that day, right? Because at the beginning, they want to have the IPO at 11 a.m. And because of technical problem, they only have the IPO at 11:30. Right? And also there's a lot of people complaining they cannot submit the order because of a technical problem, glitch, I don't know what kind of error they have. Right? Because it was one of the largest IPO at that time. All right? Okay? So if you look at the data, a lot of shares, actually more than 63 million, around 75 million shares, it was traded at 38 or 38.01 at that time. So that means what? That means a lot of shares they are purchased by the underwriter, try to stabilize. First is try to stabilize the price, and the second is buy the share and deliver to their client. All right, so that's in this case you use one stone and kill two birds. All right, so that's why this over allotment option or green shoes provision is extremely valuable to the underwriter. Okay, this is very common in IPO. Yeah.
Then why would that be an option for Facebook? Like, what is the advantage or the benefit to like the company, to Facebook?
Well, Facebook, of course, they don't want it. If you give someone an option, that means you're giving someone money. So that's why never be a guarantor of the friend or anything. Because if you become a guarantor, you actually give free money to your friend. All right? So they argue, oh no, this costs you nothing. You don't need to pay anything today. But in the future, you have to pay. All right? Because when you become a guarantor or sign anything, you actually give a free option to your friend. All right? That option is valuable. All right? So in that case, actually, Facebook, they do not necessarily want to have it. But the industry practice, right after the green shoes company, almost all underwriters, they want to have this kind of deal. Right? If you do not have the deals, maybe now the spread will be 1.5% or 1.2%. All right? But now if you have give me this deal, give me this option, well, the spread now is maybe 1.1. All right? And also, especially a big company, I would say, now I don't want to say it's a monopoly market, it's a kind of an oligopoly market for IPO. Right? A lot of big deals, they're handled by only a few major European and US companies. Right? But of course, nowadays there are more and more investment bankers from other parts of the world. India, China, they have their, large, they are huge, they are competitors now, compared to 10 or 20 years ago. Yeah, that's a good question. Yeah, why do you want to do it? Of course, they don't want to, but it depends on the negotiating power between the investment banker and the company. All right? Okay? So, now if you look at a deal, this transaction, you can do a little calculation how much money they made. The whole syndicate in this transaction, they actually make $176 million in this transaction, right? Because it's 1.1 of $38 and you multiply by 421 million shares, right? So that's the thing. Now, if you include this 63 million, even though they did not exercise it, but they pay $38 to buy it, maybe sometimes a little bit lower. Now, if they just pay this price to buy it, actually they can make more, all right? But I don't know, there's no evidence how many of those shares are actually purchased by those groups. We don't know, right? Even we see their broker ID here, but it's not necessarily by the broker, right? It may be the customer, they want to buy those shares. So we don't know, right? Exactly the share they are purchased by the underwriter or the client of the underwriter. We don't know. All right? And if you look at it in this transaction, they make this $176 million in one transaction, one deal. All right? So IPO actually is one of the big market. M&A, of course, is another one. All right? Now, Now, another thing in cash offering is what we call underpricing. Now, underpricing is a phenomenon in IPO. So what is underpricing mean, right? Now, underpricing means they argue, well, now of course in Facebook case, the price increased to 45 just a couple of days, and then over a few months, they dropped to only 18, right? Dropped to only 18. But of course, if you buy at that time, now of course you can make a fortune out of it, all right? So I still remember a friend asked me in that time, whether Facebook and Coupon, which one you should purchase. Because Groupon was also a hot company at that time, right? My answer is very obvious. Facebook, of course. Because Groupon, their business model can be easily replicated by another firm, right? But Facebook, the customer base, the number of users, it takes long time to build. All right? Of course, if you're two risk company, which one you want? Of course, I want to purchase Facebook rather than Groupon. All right? Okay? But anyway, yeah, of course, Facebook, they have the issue and everything. But all companies like this. But overpricing, underpricing argument is like this. Let's say one typical example. Actually, this is quite common in IPO market. Academic, they did research, and they looked at IPO company, and they said if I invest in all IPO company, I calculate my weighted average return. They find that you will earn an abnormal return. That is, on average, you make a huge amount of money if you just invest in all IPO. This happened not just in US, UK, Canada, China, Hong Kong, Singapore, all markets, right, for many years. All right. So they argue why this is the case, why underpricing. So if you look at, let's say, Snowflake, it was listed in 2020, just about four and a little bit more than 4 years ago. The offer price was 120. The offer price was 120. On the first day of trading, actually the starting price is 240. The first minute or first second it was 240. All right. On the first day of trading, the close price it was, I believe, is 254. So that means just one day you can earn more than if you subscribe the share initially, right? And then you sell it on the first day of trading, you make 100% return, right? That's a huge return. So that's why they argue it's very likely it's underpriced, because at the first day of trading, market they are willing to pay 254 to buy a share. Why they set the price as 120? So they argue this is an arbitrary underpricing. All right. So there must be reason for that. So of course there's a practical explanation. There are theoretical explanation about why we have this underpricing. All right. And some company their stock price skyrocket. Right, just maybe 200. It's just sometimes it's 500%, 600% in just a couple of days. Right? If you look at, I believe Nikola was one of it. Right? Nikola actually is a special case. It merged with a SPAC, right? And the price increased from $13 to around to 70 something in just a couple of days. Right? Of course, we know we read the news. It filed bankruptcy just last week. All right. But if you look at those periods at that time, well, Snowflake, the same thing, right? 254, and the highest it was around $400, right? But now it's only 164 today. So that means if you purchase at 400, you lose 60% of the investment today. All right. So they argue, well, that's underpricing, but normally it's short-term performance. Okay. Now, there's a few explanations for that. Maybe I just talk about the practical explanation. Now, if you look at it, for example, from the company perspective, of course, they want to have a higher share price. But as an underwriter, you don't want to set the price so high, because it's a firm commitment, and I set the price at 240, and suddenly nobody wants it, then I have to pay 240 to buy all the share from Snowflake. All right? Or even Facebook case, if nobody wants it, I have to pay, let's say the price drops to 18, and I have to pay 37 point something to Facebook. Okay? So as an underwriter, you don't want to set the price too high. Right? And you want to set the price a little bit low, and also all your client will make money. Everyone, when you promote it, you want them to make money. All right? So as an underwriter, you have an incentive to lower the price. But of course, you don't want to lower the price to, let's say, 1 cent or $1, because your spread, your commission, is based on the offer price. All right? So when you do this, of course, you have to do a due diligence, and you do a valuation, and then you have a team to negotiate the offer price, and you have this trade-off, right? You want to make it high so you make more money, but at the same time, you don't want to make it so high so that nobody can make money after the IPO. All right, so that's more of a practical consideration from the investment banker or the underwriter perspective. Okay, now the theoretical argument is based on information asymmetry. But let's take a 10 minutes break and then come back. We look at Professor Roth's argument why we have underpricing in